A grim start to the year with emerging market shares extending their worst start to a year since records began, which I suppose you can say means ever. Currencies slumping to record lows with their risk premium climbing to their highest in more than 6 years, and last week's Red Wednesday didn't help either, with billions of dollars wiped off stocks and currencies. This is the MoneyMakers, and I'm Bruce Whitfield. Tonight I'm looking at the risk of emerging markets and the outlook for the year. The best South African fund manager over a decade. Yes, that's true. Chris Freund. He's the head of South Africa multi-manager at Investec and also a joint manager of the Investec Balanced fund, about the shares to buy when global markets are falling. I look at the start of this year, and your colleague Chris Stewart and I often talk about this and say it's been such a long time coming, yet people react as if somebody's just taken the baby and the bathwater and thrown them out of a 10-story window. Why is everyone so surprised?
Why all of a sudden now, you say? I don't think it's been the most obvious thing in the world coming, the truth be told.
You should talk to your colleague Chris Stewart.
You're right, we do talk. But I mean, what's happened recently is there's been a good old-fashioned growth scare. Markets are reasonably highly priced right now, have had a good 6 years. And I think the anxieties about China have continued to heighten. And the Chinese policymakers, there's anxiety about them sort of losing control. We saw what happened last year when they tried to protect the currency market, they tried to protect their equity market, and just the other day they seemed to allow their currency to weaken more than the market expected. So I think that had a big impact. And then the oil price also spooked the market. It would almost suggest, that global demand, global economic strength is very weak for the oil price. It got to the sort of $27 it did last week. And I think the combination of those two has really spooked the markets that are not particularly cheap to start with.
Yeah, let's touch on oil for a second. Is it a growth problem or is it an oversupply problem? Because they're two sides of the same coin, but have two very different consequences.
Absolutely. I mean, my view and the consensus view, unfortunately, is that it's an oversupply problem. In fact, oil demand globally was up last year. Not a lot, but it was up. So it's all about, clearly, the dissolution of OPEC for the last 2 years in a row. The Saudis have effectively said, we no longer rely on us to sort of control the supply, because OPEC only controls 30% of the market. So, they really can't control the market supply with only 30%, and they've come to that realization. And then, as I'm sure you know, the sort of Iran coming on has spooked everybody as well. And then there's significant excess stock of oil around the world. So those three things has meant that the oil price has been absolutely hammered.
Now, I was very fortunate last week to be at Davos in Switzerland, and one of the presentations I went to had the Iranian foreign minister and the Iranian chief of staff address a room full of people. And people are terribly excited about Iran because they're promising 8% growth, and they've got this delicious commodity called oil, which they are very determined post-sanctions to bring onto the market. Why should they hold back? They need foreign revenue like every other country in the world, so they're going to bring that oil on come hell or high water. It does suggest the oversupply story is the story of oil.
It's going to stay with us.
And then the other story was China. And everybody's got an opinion on China. None of the opinions collide. But the sense was the IMF is believing China grows 6.5% this year. The Chinese authorities who were there last week, the deputy head of the central bank and others, all suggesting that China will pull out whatever levers it needs to keep the growth, the 6% growth story going. It doesn't seem like a disaster.
I actually agree. I don't think it is a disaster. I mean, there is great anxiety in the markets about a disorderly slowdown in China. I mean, China has been slowing for a couple of years now, from the 10% GDP growth rates it had a number of years ago down to, as you say, sort of 6.5% this year. So that it's slowing is not the issue. It's just that, does it turn into a rout, the slowdown? And certainly the infrastructure or the hard economy side of China looks like it is slowing quite quickly. Witness the overcapacity in a number of key sectors of steel and cement and issues like areas like that. That does look like it's slowing in response to the excess housing, too many houses in the smaller Chinese cities that now have got excess inventory. Yeah. But outside of that, it looks fine. And I mean, for what it's worth, you say it's tricky, but for what it's worth, our view is that the Chinese authorities won't lose control. They have already put in enough sort of fiscal or tax-related type of measures in place, interest rate type measures in place, that it will actually continue to slow in an orderly way.
But do they have any choice but to devalue their currency further this year? Because that seemed to be also consensus at Davos, was the Chinese will have to have probably greater levels of currency devaluation this year, which ultimately is also negative for other emerging markets like ourselves.
Correct. So, again, my view on that is slightly different in that the world is obsessed with the Chinese renminbi US dollar rate. And I think I heard the Chinese authorities say some time ago that they are no longer looking to sort of target their currency or keep their currency in rough parity with the US dollar, but against a basket of currencies. So in fact, I think the dollar has strengthened against the rest of the world. So many other currencies have weakened against the dollar. And I think the Chinese, all they've done is change their policy from pegging their currency to the dollar to a trade-weighted basket of currencies. And in fact, that's all they've done. So to cut a long story short, I don't necessarily think that you're going to see a big depreciation of the renminbi from here, a big further depreciation. But it sort of is a bit of a circular argument. You know, do you believe, what's your view on the dollar, the US dollar? Now it has been strengthening tremendously, as I said, over the last couple of years. Again, you pays your money, you takes your chances. My view is that is coming to the end. And the way I would, look at whether that's correct or not is look, for example, at the headline US dollar euro exchange rate, which has been oscillating between 105 and say 150. And that is what I would expect to continue for the next while. So, long story short, I don't expect the Chinese currency to have a big leg further of depreciation.
I mean, your fund's 10-year performance at number one, you understand markets better than most. So the stats would suggest. So, based on the fact that we start the year in absolute carnage and chaos and mild panic, it wasn't wholesale panic, it was mild panic. What do we do? There are a lot of South Africans who feel down in the dumps right now. Nenegate still looms large over South Africa. There's a lot of trepidation ahead of the State of the Nation address in the next couple of days, the budget in the next couple of weeks, and markets which are looking decidedly tastier than they were 6 months ago. The temptation is to leap right in with both feet.
Leap into the market. Yeah. I mean, my pacemaker nearly stopped on the 12th of December. I'll tell you when I read what was going on there. It was astonishing. And people are incredibly depressed in South Africa right now. The business community I have never seen so low.
Well, business confidence is at its lowest levels.
Correct.
Since business confidence.
And you can just see it when you talk to people. You can hear it when you talk to people. I personally think people are maybe getting overly negative, but I must tell you, my street cred is not particularly good in this area. I'm sort of the last optimist standing, and have taken a big beating. But markets have been, a lot of our shares in the JSE are global shares, as you will well know, shares like British American Tobacco and South African breweries, and they do very well out of rand weakness. So in fact, our equity markets haven't done too badly at all, but the domestically orientated shares, the banks and the retailers, have been caned very hard. My sense is that it's too late to expect a lot more currency weakness, but as I say, that view comes with a big health warning of being wrong for a long time. But if I look at a really good piece of research I read the other day from a guy at RMB who wrote it, I can't remember his name. He took out the rand, because the rand is going to have such a big impact on the market's performance, on your and my pension fund over the next year. He took three elements to the rand weakness. The first, he said, look, it's the dollar's been strong, okay? So everything is weakened against the dollar. So that accounts for roughly 30% of the rand weakness over the last 4.5 years. The second thing he looked at was, he said, but look, commodity prices have fallen around the world. That's bad for commodity producing countries. And he looked at even a basket of commodity producing countries like the Aussie dollar, the Canadian dollar, Chilean peso, etc. So that accounted for another 30% of the rand weakness. So you're left with 40% of the rand weakness was SA-specific issues of us, taking the bazooka out and shooting ourselves in the foot. Now, sentiment is so negative already about South Africa. I'm just not convinced that it gets worse from here. I think Pravin Gordhan is signaling loud and clear to you at Davos that there is a relatively prudent budget coming in on the 24th.
I think it's more than relatively prudent. I think he's going to take the sickle and slash wherever it is possible to slash.
Right.
Kganyago backed him up on that, saying we are saying fiscal prudence is the course of action. The trouble is, in Davos, people are so worried about their own backyards, they weren't particularly interested in listening to us. So we were kind of talking into ourselves and into a vacuum, it felt like.
Right.
So
no, they're not interested in us now. We have fallen right off the global scale of interesting countries to look at. But that's beside the point.
2 minutes. I need to know what to buy. Is it worth buying anything yet or not?
Yeah, but the active managers are going to beat passive managers by a country mile in the next while. So it's not a rising tide lifts all boats. You have to be very specific about which shares you're going to buy. So, I mean, we think that Sappi is going to do very well. I need more time really to flesh that out. We think that Tiger Brands, bizarrely, is going to do very well.
Why bizarrely? I mean, Tiger Brands is so well positioned with such great brands.
Well, I agree with you, but everyone goes on about the drought effect on Tiger Brands' maize business. Well, we've looked back, over the last 20 years, our research team has looked back and says people always overestimate the negative effect of a drought. And they sold Dangote, which is going to have a big impact on that business. So there's specific stocks, Tigers, Sappi, Naspers, we still like a lot.
I saw Chris Becker last week, and he's got investments in China, in Russia, in Brazil.
Right.
But he's like the knights who say ni. He can't be taken down. I mean, he's really quite resilient and quite pleased with himself.
And Old Mutual, I think, is the worst kept secret in the world. The Old Mutual board are looking very seriously at splitting that business, the London Old Mutual Wealth business, and the rest. And even within the rest, there might be certain corporate actions that are potentially taking place. So you've got to have a proper team of analysts and PMs who do the work and do the legwork, as opposed to sort of buying the index.
Okay, Sappi, Naspers, Old Mutual, and the other one, I've already forgotten, Tiger Brands.
Tiger Brands, and then we like Vodacom a lot. We think that management team is outstanding. And funny enough, South Africa, telecoms in South Africa is not doing so badly. We could let's not get into the MTN Nigeria story. No. But actually, have you noticed that your cell phone bill is going up?
Yes.
Yeah, precisely. They've started to behave a bit more rationally, they would argue, in that Cell C is no longer taking the market out at the knees. So Cell C's, tried to dress itself up for sale. That didn't work, and they're trying to now organically grow. And so everyone is behaving more rationally and basically putting up your prices. So the only way you can get them back is to buy their share.
There we go. That'll teach him. We'll pay for the bills with the dividends. Thank you very much. Chris Freund. Chris Freund is the head of South Africa multi-assets at Investec. Thank you for watching. There'll be more investment and insights in the show in the next couple of weeks. Of course, on tomorrow's show as well, more Moneymakers. Till then, bye-bye.